What's up everybody, Gen X Dividend Investor here. In this video I'll analyze a subscriber's dividend portfolio, then we'll tell you if I love it, hate it, or something in between. And if you'd like to show your support, then please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Note I'm not a professional wealth manager, so don't take anything I say as financial advice. Okay, I plan to run a poll on the community tab of my YouTube channel so that you can vote on this portfolio. That way we can see how everyone feels about it, not just me. In the last subscriber portfolio review I did, I said that I would give it a thumbs up, and then 846 of you voted and 86% of you agreed with me. And if you'd like me to review your portfolio in a future video like this, then Instagram me at Gen X Dividend Investor and tell me anything you'd want to share about your portfolio and yourself, like your reasons for your investments, how old you are, your goals, career, retiring timeline, investing experiences, etc. I have a bunch of people who've already submitted portfolios for me to review. And when I do these videos, I don't pick them based on the order in which they were submitted, but instead based on what I think would be interesting and valuable to watch. So today's portfolio came to me from a Patreon Aristocrat subscriber of mine who wanted to remain anonymous, so I'll just call her Betty. Betty went to university and then got a job in the media industry, and eventually she transitioned her career into hotel management. Her first foray into investing was after she read Rich Dad Poor Dad by Robert Kiyosaki. I think it's worth a read even though I don't agree with everything he says, so I'll include an Amazon affiliate link to the book in the description of this video. As an Amazon associate, I earned from qualifying purchases. After reading Kiyosaki's book, Betty saved enough for a down payment on a condo, then she lived in it for a while until she sold it for a great profit. Then she bought another condo, sold it for a profit, and now is on her third place. There are lots of ways to make money with real estate, from ongoing rental income to capital appreciation from selling. Interestingly, Betty said that some of her friends and family tried to dissuade her from investing in real estate, but she's glad she ignored them, and I could relate to her experience. I mean, when I was buying my first house after college, I was visiting my parents and one of my favorite relatives was over and tried to convince me not to buy. He felt that mortgages were too stressful and that renting was better. But I ended up buying a house anyway, and I'm really glad I did. My wife and I found a place that we loved, and we put an offer in at 20% below asking price, even though our realtor told us that the seller would never go for it. Fortunately, the seller accepted our offer, and we ended up living there for a few years before selling it for a nice profit. A good thing to be aware of is that if you've owned and occupied your house for at least 2 of the last 5 years and then you sell it, then you can avoid paying capital gains taxes on the first $500,000 of profits for married people filing jointly. So like if you've bought a house for $500,000 and then you've lived in it for 2 years and managed to sell it for $1.2 million, then you'll only owe capital gains on $200,000 since $500,000 of the profit is tax-free. Note, you can only do that once every 2 years, and there are other considerations to be aware of, like the home must be considered your principal residence based on IRS rules. I've been able to use that tax benefit multiple times over my life, and if you saw my video called Watch Me Buy $450,000 of dividend stocks in my $2 million portfolio, then you'd know that the $450,000 in question was from the profit of selling my house. Anyways, Betty made enough profit on her condos that she decided to take a meaningful amount of time off work and then travel the world to inexpensive places. She's been going around South America and Asia and such, experiencing their amazing food and cultures and geographies. But Betty had never thought about investing in stocks until she stumbled on my channel on YouTube and became interested to learn about the truly passive income potential from conservative blue-chip dividend stocks. Now her goal is to build a large enough dividend portfolio so that between its income and some recreational employment, she'll be able to continue traveling around the world. Right now she has around $100,000 cash to invest into a portfolio, but she hasn't pulled the trigger on buying any stocks quite yet. So this video and your comments will all act as info to help her figure out what to do. And to reiterate, I wouldn't blindly follow investing advice that I, or anyone, says, but I do think it can be useful to hear others' opinions when you're formulating your own strategies. Always do your own due diligence and factor in your risk tolerances and life goals and such, and consider talking to a wealth management professional. So basically Betty's plan is to build her portfolio over the next 5 years, and then hopes between that and fun side gigs to be able to do what she wants. I asked her what stocks she was thinking about going into, and these are the 9 she mentioned. And her initial thought was to evenly spread her $100,000 into each position. I put her desired stocks into my portfolio tool so I could see what various things look like, such as the starting yield and dividend CAGR, the overall portfolio sector composition, how the dividend income would potentially grow, etc. Oh, and you can ignore the price and daily change columns, as I put in some temporary data representing stock buys moments before I took the screenshots. I ordered the tickers alphabetically, and you can see that she wants to go with Coca-Cola, McDonald's, Realty Income, Pepsi, Procter & Gamble, Starbucks, SCHD, VGT, which is Vanguard's tech ETF, and VU. My first comment is that these are all solid, long-term stocks and ETFs, so great job there. And I'm actually long many of these tickers, so if you want to see my complete portfolio, then watch a recent video I did called $98,800 of dividends per year from my $2.8 million dividend portfolio, where I showed you all my stocks in my Fidelity account. I see that you have some single stocks and some broad market ETFs like VU, which can give you good sector coverage, but I can tell that your sector composition will still be heavily in consumer staples and basically non-existent in other areas, which generally isn't ideal most of the time. I think a good goal is to get market-like returns, but ideally with a higher yield, which can be tough, but it's possible. But a challenge you'll have with investing in only conservative blue-chip dividend stocks is that your current yield might be too low for it to be income-producing enough in the short term, and I'll show you what I mean in a moment. The good news is that most of your tickers will have the potential for qualified dividends, which is usually tax efficient if held in a taxable account, depending on your other income. Even more tax efficient might be holding an MLP like Enterprise Products Partners, a ticker I'm long in. This Seeking Alpha screenshot tells us that EPD provides midstream energy services to producers and consumers of natural gas, oil, etc., i.e. it's an energy company that stores and transports oil and natural gas and such. It's a master limited partnership, and part of its dividends, which they call distributions, may be taxed as ordinary income, part of which may be treated as capital gains, and most of which I believe may not be taxed at all for a period of time, since it should be a return of invested capital. You can watch a video I did called BDCs and MLPs and REITs, oh my, where I dive into some useful information about investing in MLPs. Another nice aspect of EPD beyond its tax implications is its current distribution yield of 7.5%, plus it has over 20 consecutive years of dividend growth, though it only has a low 2.6% 5-year dividend growth rate. Now, never invest in something just because of its yield, but as part of a holistic investing strategy, you might want to include some higher yielding solid stocks to balance out your super conservative stuff. And of course, make sure all your stocks align to your desired sector composition and have solid financial metrics and moats and such. This part of my portfolio tool shows you what I mean. Here we can see the current yield and dividend CAGR of each of the tickers you mentioned. So like Coca-Cola has about a 3% yield and a low 3.48% historical 3-year dividend growth rate. McDonald's is only at a 2.1% yield, but has a nicer 8.39% dividend CAGR. O is your highest yielder at 5.1%, but is also the lowest dividend grower at 2.7%. This portfolio's average weighted yield is only 2.6%, which means a $100,000 investment would initially be yielding only about $2,600 a year. That breaks down to about $219 a month in passive income, or $50 a week. Of course, that doesn't count any stock appreciation returns. But is that amount of cash enough to meet your needs? One option is to realize that interest rates are currently super high, so it's possible to find 5% interest-bearing accounts pretty easily, which would generate an almost risk-free $5,000 a year, assuming they stay that high, which I doubt they will. And there's also treasuries and bonds and such. So spending some time figuring out what your future state portfolio should look like, all the while accruing that nice interest, and then placing buy orders when specific tickers are cheap, is not a bad idea. Of course, long-term the US stock market, on average, has outperformed almost all other asset classes out there, especially cash in the bank, though there have been periods like this where bank interest shines. So while I personally wouldn't want to sell my stocks and owe taxes on the gains and then put the remaining cash in the bank to get that 5% interest, I would be okay sitting on cash if I had it invested. If you went with stocks and we looked at how that income would come in, we would see that your forward monthly totals would be $285 a month, followed by $194 a month, and then $177 a month, and then that would repeat quarterly. We also see a couple rows representing your no-drip dividend income estimates on top, and your drip income estimates on the bottom, for 2 decades out. So if your dividend CAGR held for multiple decades, then your portfolio would be yielding about $14,000 a year at year 21, or if you've been reinvesting your dividends, which you don't plan to do for that long, then you'd be making $25,000 a year. Nice. But let's take a look at the earlier years, which is probably a more accurate estimate of what your income would look like, because the further you go out, the less estimates tend to be useful. We see that by year 5, your portfolio yield would have increased to about $4,000 a year if you stuck with these super conservative stocks. Of course, if you up your yield a bit, then you could be double or even more than that. Okay, so now let's take a look at your stocks. I'm not going to do a stock analysis on each ticker, as this would turn into an hour-long video, so I'll just share the price I'd buy at and mention some quick thoughts about each one. But remember, you always want to do deep dives to understand more about your investments, like how their key financial metrics have been trending, what their growth prospects look like, how they fare in their evolving industry, etc. And finally, another option to consider, and one I'd probably do, would be to add in some higher yield tickers like Devo and JEPI, which will give you more income potential now, along with broader sector composition than individual stocks, though with some different risks to be aware of. I did a video called SCHD versus JEPI versus Devo versus VTI, who wins, which I recommend you watch. And note, if I were a young person trying to grow my net worth, then I'd probably avoid things like Devo and JEPI, which are generally more suited for income than capital appreciation, even though sometimes they'll have great appreciation. Another thing you could do to increase your cash flow would be to learn how to do conservative option plays, which is a more active thing, but it could become one of your recreational employment side gigs. Basically, it's another way you could potentially increase your income from your portfolio if you're willing and able to take on some more managed risk. Or you can outsource that to fund managers like Devo and JEPI and let them do it for you, or do both, or neither. Other tickers I own which generate more yield now, but have their own risks to be aware of, include Altria, ticker MO, British American Tobacco, ticker BTI, Duke Energy, ticker DUK, and AbbVie, ticker ABBV. Anyways, let's take a gander at your tickers. So first we have Coke, which is a classic dividend stock that I'd buy when it's under $55. I think one risk to Coke is its upside is kind of limited, though they can still achieve gains with new product innovation and acquisitions, along with some pricing power. A risk, albeit minimal, are global consumer health perspectives that are evolving slightly away from sodas. But there are still a lot of people, like me, who love their Diet Coke. Next you have McDonald's, another classic dividend stock, and another stock I feel is pretty recession resistant. I'd personally like McDonald's under $220. I feel like the main risk with McDonald's is its price, so some upside concerns for now, but long term I still want it for part of my portfolio. McDonald's may have some health headwind concerns, but I think people will keep eating fast food for the rest of my life. One interesting stock catalyst for McDonald's could be once they nail down automation and AI, all of which could lead to better, faster, and ultimately cheaper products. Next you have Realty Income, and I like O at these prices, so under $60. They have a great diverse portfolio of properties at great occupancy rates, and I like how they got out of their office commercial real estate at a great time. I also like how they're expanding lately. Obviously interest rates and a potential worldwide recession has some people worried, but I see that as an opportunity. Next up is another strong dividend play in Pepsi, which recently became a dividend king. I like Pepsi under $150, but that's a decent drop from here. Pepsi's been able to use its positioning to drive price increases, but that can be hard to sustain long term. Of course, they can continue to innovate and acquire companies as other ways to move the growth needle. Next up you have another amazing company in Procter & Gamble, something I'd like under $120. They have a very strong product portfolio, but one thing I wonder about for companies in this space, including Kimberly-Clark and Colgate-Palmolive and such, is if their brands will slowly lose their luster as cheaper competitive brands keep moving in from companies like Amazon. Regardless, price is my biggest concern with them. Next you have Starbucks, another great company. One risk to Starbucks are the unionization efforts that are broadening, but long term I think they'll still do fine. I feel it's a tad pricey right now, but not too unreasonable. $90 would be nice. Next up is my favorite dividend ETF, SCHD, which has had a hard 2023 as risk-on assets become more popular, but that makes it all the more interesting right now to invest at these prices. SCHD is a nice way to get dividends without dealing with all the micromanagement of tracking individual companies. Then you have another solid ETF in VGT, and long-term I'd bet VGT will outperform most ETFs out there. I'd never bet against tech in the long run, which is why my kids' personal portfolios are overly weighted in tech. Finally you have VU, which is another great long-term hold. Now I previously talked about sector composition, so let's take a look at what this portfolio looks like. So your ETF bucket is your largest, which is fine, but then consumer staples is 33% of your portfolio, with 22% of it coming from food beverages stocks and 11% coming from household stocks. Having 1/3 of your portfolio in consumer staples is quite a bit. Then you have 22% consumer discretionary and 11% in real estate. Now to be fair, your ETFs gives you a bit of each sector, generally speaking, so that's better. Thus it's not necessarily something you have to change, but I'd probably look to some aristocrat and king stocks in underweight sectors and analyze if there'd be good fits for you. If we look at your annual passive income by sector, we see that 25% of your income comes from ETFs, and then about 35% comes from consumer staples, which is quite a bit. Then about 21% comes from real estate, which is quite high relative to the overall market, and then consumer discretionary is about 18% of your income. So again, I think I'd strive for a bit more diversification in single stocks. Like, I'd recommend you strive to have 20 to 30 individual stocks, and then weight your stocks based on your belief in their future potential. I'd stay away from any single ticker being more than 10% of your portfolio as a general guideline. But if the ticker is a broad market ETF, then I'm fine with it being more than 10%. I'd also look at the overall market sector weighting and then drive your personal portfolio closer to that. Like if VTI says that healthcare stocks are about 14% of the market, then go with that. Of course, since you own some ETFs, you'll need to do a bit of work to more accurately reflect what your portfolio sector composition looks like between single stocks and your ETFs. Another good rule of thumb is to hold a couple of tickers per sector and go with the 2 most dominant companies that exist rather than smaller ones. It's okay if you want to hold more or less, and it's okay to not hold tickers in each sector, but I'm just sharing my guidelines. Again, my goal is to try to get market-like returns but with a higher yield. And a good way of doing that is to basically mirror the market. I'd also use Dividend King and Aristocrat lists when identifying potential stocks I want to own. But good start overall. Okay, and what sort of rating would I give this portfolio? Well, I like the direction you're heading, but I think you need to continue refining what you want your future state dividend portfolio to look like. Ultimately, I don't love it, nor do I hate it, so I'll go in the middle and say it's mediocre for me. That doesn't mean you shouldn't go for it though. I'll leave a poll in the community tab of my YouTube channel, where you guys out there on the interwebs can vote that you love it, or that you think it's mediocre, or that you hate it, and then I'll share the results in the future. Remember, if you'd like me to review your portfolio, then Instagram me your stocks at GenXDividendInvestor, and tell me info about yourself like your age, goals, career, retiring timeline, investing experience, etc., and maybe I'll highlight you in a future video. Now, I'd normally call out my newest Patreon, Aristocrat, or King signups, but I'm currently all sold out. So instead I'll pitch my Seeking Alpha affiliate link in the description of this video as well as in the pinned comment. Using it lets you try Seeking Alpha Premium for 14 days for free, and you can cancel at any time during those 2 weeks, and then they charge you $239 for a year's access. I personally paid $239 a year for premium access for multiple years, mostly because I valued the articles in the comments section so much, to the point that I literally will never buy or sell a stock without first reading all that information. And double check what they're offering if you click on my link, because they change the sign up deal every so often. Oh, and if you appreciate when I do free dividend investing videos like this, then please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, I highly recommend that you join my free Dividend Discord chat server, which has over 10,000 dividend investors on it from 72 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.